You are watching Market Watch, the brief overview of the key events from the world of finance. Today we will talk not only about the Federal Reserve and the prospect of lowering the key interest rate, but also about how and why the market reacts to all this in this way. But let's start with inflation, which only the lazy don't talk about. It's still very high. The fact is that the target level is at 2%, but the last time the Consumer Price Index in the United States was below 2% in early 2021. Recall that from January 2019 to March 2020, inflation rose above the target level, but only for 4 months. Now it has been held above 2% for 38 months, and precisely because of this, the current state of affairs is extremely unusual. Due to the prolonged period of high inflation, the Fed has been holding its key interest rate at a 20-year high for more than a year. Recall that before the 2008 financial crisis, the key interest rate was kept above 5% for more than a year, but the fight against inflation ended in high-profile bankruptcies and, as a result, the global financial crisis. It is extremely difficult to rule out a repeat of this scenario in 2025, because according to the tool presented on the FIBO Group website, which estimates the probability of a change in the Fed rate, this probability is decreasing. A month ago, the probability that the rate would remain at the same level in September did not even reach 39%, but today we are talking about 51%. It can take a long time to list the percentages of the probability that the Fed will not go on a rapid interest rate cut this year, which in turn increases the risk of a force majeure situation. But pay attention to the calmness of the market. Key stock indexes are trading at historical highs ahead of the next release of inflation data and the Fed's decision on the key interest rate. But this calmness may turn out to be an illusion, and we will find out if the Fed representatives remain steadfast, adhering to a tough stance on monetary policy. We have repeatedly observed sell-offs on the stock market at a time when the probability of easing the Fed's monetary policy has significantly decreased. This sentiment extends to the cryptocurrency market as well. But it is important to understand not which markets are reacting, but why. The reason is that institutional investors are aware of the risk of impending financial disaster. That's all I have. Follow the news carefully and be prepared for all the surprises of the market.